Welcome. Today, we're diving deep into a really critical part of the new Income Tax Act 2025. We're talking about how income from your house property gets taxed. Now, whether you own just one home or have a portfolio of properties, understanding Section 20 is, well, absolutely key to managing your finances. So let's get right into it. Let's kick things off with a very common scenario, one that I'm sure many of you have thought about. Imagine you own two houses. You live in one, but the other one is just sitting empty. The big question is, do you still have to pay tax on that vacant house? It's a fantastic question. And you know what? The new act has a very specific and perhaps surprising answer. Let's find out what it is. So, to get to that answer and understand the whole picture, here's our game plan. We'll start with the absolute foundation, Section 20. Then, we'll get into the nuts and bolts of calculating what's called the annual value. After that, we'll look at the power of deductions, run through a real-world example, and wrap up with some crucial compliance tips and the main takeaways. All right, first up, let's get to the heart of the matter. Section 20 is really the starting block. It's the provision that lays down the fundamental rule for how any income from your properties is taxed. Everything else we discussed today builds on this one section. Okay, so what does the law actually say? It says the tax is charged on the annual value of the property. Now, this is a super important point. It's not necessarily about the actual rent you pocket, but about the property's potential to earn income, its annual value. This is the entire basis of the calculation. So the first thing we always need to figure out is this annual value. Now, for this section to even apply, three simple conditions have to be met. Think of it as a checklist. First, obviously, there has to be a property, a building or land attached to it. Second, you, the taxpayer, must be the legal owner. And third, and this is a key distinction, you can't be using that property for your own business or profession. If you are, any income from it is taxed under business income, not here. Okay, so we know the tax is based on this concept of annual value. But how on earth do we calculate it? It's not just a number you pull out of thin air. Let's break down the process of how we get from a gross value all the way down to the net taxable amount, which is all laid out for us in Section 21. Section 21 actually gives us a nice, clean, four-step process. First, we figure out the gross annual value, or GAV. Now, the GAV is simply the higher of two figures, the actual rent you're getting versus what's called the expected rent, which is basically the fair rental value of the property. Once you have that GAV, you subtract any municipal taxes that you, the owner, have actually paid. What's left? That's your net annual value, or NAV.
Now, here's where things get really interesting. The law treats properties very differently based on how you use them. For a property you've rented out, a let-out property, we do the calculation we just talked about. But for a property you live in yourself, what we call a self-occupied property, there's a massive benefit. Its annual value is simply taken as nil. That's right, zero.
And this right here is the answer to our opening question. Under the new Act, Section 21, you are allowed to claim up to 2 properties as self-occupied. This means for 2 of your houses, you can declare their annual value as nil. This is a pretty significant relief for homeowners, especially those who might have a family home in one city and another for work. So if you live in one house and the other is empty, you can treat them both as self-occupied, and their notional annual value for tax purposes is 0.
Okay, so we figured out the net annual value. But we're not done yet. Now comes the really good part, deductions. Section 22 gives us some powerful tools that let us reduce that NAV even further, which means, of course, a lower tax bill. Let's see what they are. You basically get 2 main deductions. First, there's the standard deduction. This is a straight, flat 30% off your net annual value. It's meant to cover your general expenses like repairs, painting, insurance, so you don't have to track every single rupee. The second big one, and often the most substantial, is the deduction for interest you've paid on a home loan.
Let's dig into that interest deduction a bit more. It's not just for buying a house. It also covers loans for construction or even repairs. But there's a fantastic detail here under Section 22C that many people miss: pre-construction interest. Any interest you paid before the property was even finished can be claimed as a deduction. You just have to claim it in 5 equal parts, over 5 years, starting from the year the construction is complete. A real pro tip, that one. All right, theory is great, but let's make this real. We've talked about all the rules and provisions. Now let's see how it all works in practice by walking through a simple, straightforward calculation. Let's meet Mr. Sharma. He owns a property in Delhi that he's rented out for 30,000 rupees a month. During the year, he paid 20,000 rupees in municipal taxes, and the interest on his housing loan came to 70,000 rupees. So the question is, what's his taxable income from this house? Let's crunch the numbers together. His gross annual value is 30,000 times 12, which is 3,60,000. From that, we subtract the 20,000 in municipal taxes he paid. That gives us a net annual value of 3,40,000. Now for the deductions. First, the standard 30% deduction on the NAV, which works out to 1,02,000. Then, we subtract the full 70,000 he paid in loan interest. And there we have it. Mr. Sharma's final taxable income from this property is 1,68,000 rupees. Simple as that. You know, knowing how to do the math is only half the story. Being compliant and, more importantly, avoiding those common mistakes is just as crucial. So let's cover some really practical points you need to be aware of. So here's your quick compliance checklist. First, and this is a big one, to claim that home loan interest deduction, Rule 151 says you must provide your lender's PAN details. No PAN, no deduction. Second, if you're a salaried person and these deductions actually result in a loss from your house property, you can declare it to your employer. This will help them calculate the right amount of TDS to deduct from your salary. And third, always remember the deemed owner rule in Section 25. For instance, if you transfer a property to your spouse without receiving proper payment, for tax purposes, you are still considered the owner. And let's quickly touch upon a few common tripwires. We already talked about it, but people often forget to claim that pre-construction interest over 5 years. Don't leave that money on the table. Second, what about rent a tenant never paid? Well, under Section 23, that unrealized rent is only taxed if and when you finally get the money back. And finally, here's a very important note on the transition to the new law. The official FAQs clarify that if you had any house property losses carried forward from the old 1961 Act, you can still set them off against income under this new act. Wow, we have covered a lot of ground today. So let's take a moment and just boil it all down to the most essential points, the key takeaways you absolutely need to remember from our discussion on income from house property. If you remember nothing else, remember these 4 things. 1. Tax is based on annual value, not just the rent you collect. 2. The big one, you can claim up to 2 properties as self-occupied and pay 0 tax on their annual value. 3. Your 2 best friends for saving tax here are the flat 30% standard deduction and the deduction for home loan interest. And finally, 4. Documentation is king. Keep your municipal tax receipts and your lender's PAN details handy. And that really covers the A to Z of how income from house property works under the new act. So with this new understanding, the final question I want to leave you with is a personal one. How will you use these rules to better plan your property investments and your tax declarations for the upcoming year? Thank you so much for watching. If you found this explainer useful, we'd really appreciate it if you could like, subscribe, and share it with colleagues or friends who could also benefit from it. Just a quick and important reminder, this explainer is purely for educational purposes and should not be taken as professional advice. Tax laws can and do change. Please always consult with your professional advisor before making any financial decisions. This is an AI-generated educational explainer.